Okay, we'll go ahead and get started this morning. So thank you all very much for joining me this morning. My name is Jason Mishaw, and I'm one of the financial advisors here at Bogart Wealth. I'm going to talk to you today about the American Rescue Plan Act of 2021, which is the official name for the $1.9 trillion stimulus plan that was recently passed by Congress and signed into law by President Biden, that we've been hearing so much about in the news recently. So before I get started on the presentation, a little bit about our firm. So Bogart Wealth is a registered investment advisory firm. We manage just under $1.4 billion in assets under advisement. With the recent growth that we've had, we have just around 800 clients and families that we work with. And the vast majority of whom, about 90% of our clients, are either retirees from major oil companies or current employees there. So we are true fiduciaries for our clients, which means we are legally obligated to put our clients' interests ahead of our own. So that involves transparent fee-only services, full disclosure, and things of that nature. So with the recent growth that we've had, we have about 20 employees. So you can see members of our team here. And then we also have 4 colleagues in our tax team, headed by Troy O'Callahan, CPA partner, so handles our tax preparation and tax planning for our clients. We have 3 office locations, the first in McLean, Virginia, where the company was started. And then we have 2 in the Houston area, 1 in Gessner on the west side of town, and then 1 in the Woodlands for our clients. So, our mission is to provide, help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. So you can see our core competencies listed here: holistic planning, tax planning, investment management. So these are a lot of things that we do for our clients, which you can see here. So now on to the meat of the presentation. And before I do that, I do have the chat box and the question and answer box open. So if you have any questions as I'm going through the presentation, please feel free to jump in and write them, and I'll try to answer as we go along. And if I don't have the ability to get to it while I'm talking, I'll try to address at the end, but I certainly encourage and welcome your feedback as we go through. Okay, so on to the meat of the presentation, so the act itself. So, given the scope of the bill and the fact that there are significant funding assignments to a lot of different areas, the scope of which is too big to go into today, we'll kind of focus on some of the bigger areas of impact that affect individuals, so including the stimulus payments, unemployment benefits, health insurance benefits that kind of target individuals. And we'll kind of address those, and then going down the road, if there's other areas of the act that you want to address in a future webinar, we'd be happy to do that and welcome feedback in that regard. So, this is the third iteration of our stimulus spending. We started with the CARES Act in March of 2020, and then the Consolidated Appropriations Act in December of last year. So this is the third one. This is, the focus on this act is definitely more on individuals and government programs. Where we saw the CARES Act was, we did have the stimulus payments. We also had the PPP loans targeting businesses to help them stay open and keep payroll going. Now we're seeing more targeted spending in government programs, in addition to individuals. And then thirdly, state and local governments and school systems as well. In addition, we have appropriation for additional vaccines and testing. So we're seeing a little bit more of a transition to individuals and state and local governments addressing that ongoing crisis. So we're seeing a little bit of a shift in the metrics with this third iteration of our relief spending. So, on the agenda, some of the items we're going to hit, the big picture, what is the big allocation of the funds, and then some of the individual items that particularly affect individuals. Will you get a rebate? Will you qualify for a stimulus check, and how much if you do so? What are the extension of the unemployment provisions, and then health insurance? And then we also had a pretty robust expansion of some of the tax credits that affect working families as well. So we'll kind of hit some of those items as we go through and kind of our overview today. So the first piece is based on this estimate from the Congressional Budget Office, is kind of the estimated cumulative spending from this package. You can see that the biggest line item, of course, is the stimulus checks going to individuals. So you see that that is estimated to be just over $400 billion. So that's the biggest piece. And then also to individuals, increased unemployment assistance. So that's about projected to be around $240 billion. But then you can see right behind that is payments to state and local governments, as well as to education systems for both higher ed and K through 12, to provide funding to school districts to get things opened back up, so kids can kind of start going back to school. So you can see the meat of this spending plan has definitely been a little bit of shift from the a little bit more business centric spending with the CARES Act. And then you can see also some more individual items. So some of the tax credits, the cost of those, child tax credit. We had some transportation infrastructure, some more support for local transit as well as aviation. We had some funding for pension programs, and then other tax credits. And then you'll notice here, raising the federal minimum wage, you notice that that's darkened in gray. So that was actually a proposal. We've heard in the news the increase going from $7.25 an hour to 15 for the federal minimum wage. That was actually incorporated into the House's version of the bill, and it did not pass the Senate. And so that was taken out for the finalized version. But it is interesting to note that that's kind of lurking in the background. That was pushed as part of the bill. So it'll be interesting to see what happens as we get to, further legislation or down to 2022, the next election cycle. But it's something to take note that is definitely on the forefront of legislative priority for the new administration, is working with that minimum wage, and as evidenced by the fact that they tried to incorporate it in the House's version of the bill. So it's interesting to know that is in there. So that's kind of the big picture of where overall where a lot of these items are. Again, as we said, we could spend hours kind of diving into the specific expenditure. So that's not the goal of the presentation today. And if we want to address that in the future, please feel free to comment or inquire about that. Okay. So going on to the first question of the stimulus check. So you'll notice that as I'm sure many of you have seen, that these numbers are more robust than the previous iteration. So we can get up to $1,400 for an individual, and then times two, $2,800 if you're married filing jointly. And then families will also receive an extra $1,400 per dependent. So a family of four that meets the adjusted gross income requirements could potentially get $5,600 as a stimulus payment. So definitely very robust stimulus payments. And then we have a little bit more stringent phase outs for adjusted gross income. So for individuals, as their adjusted gross income or AGI exceeds $75,000, it starts to phase out pretty quickly. And then $150,000 for married filing jointly, or head of household, $112,500. So you notice in this chart right here, you can see the phase out window is very narrow. It's about $5,000 for an individual, and that's phased out on a pro rata basis, bringing it down to zero if an AGI of an individual is over $80,000. And similar to the previous payments, so these are considered to be credits against your 2021 taxes, but are fully refundable and paid in advance, meaning there's no obligation to pay anything back at the end when you file your 2021 tax return. That was a common misconception when they first started coming out, but there's no obligation. These numbers are going to be based on either your 2019 adjusted gross income, if you haven't filed your 2020 return, or your 2020 tax return if you filed that. So that's something to be mindful of. And then additionally, payments to which a taxpayer is entitled but did not receive as a function of a change in income. So for example, if their 2020 adjusted gross income as an individual was $85,000, but it dropped to $70,000 in 2021, they can actually apply for and get that credit on their tax return as a recovery rebate when filing their 2021 tax return. So we have seen some clients who are kind of looking at some income arbitrage, paying attention to where their adjusted gross incomes lie, if they're in this range, to be able to qualify for a stimulus, whether that be if their 2020 income is too high, they hold off on filing until the payments go out. or looking at their 2020, 2021 taxes to make sure they fall under that threshold. But these are definitely some things to consider when getting your stimulus check. So as we said, that's kind of one of the biggest pieces, the biggest outlays of this relief bill. And if we move to the next component is the unemployment provision. So, and this was kind of a point of contention in Congress. They were debating $400 weekly versus $300. So they settled on $300 as a compromise. But we extended the $300 weekly benefits to those collecting unemployment through Labor Day, which is September 6th of this year. So if you'll notice, again, we kind of have the timeline of the extension. So the first CARES Act gave 39 weeks. That was the more robust at $600 per week. And then we had the consolidated appropriations extending through the middle of March. And then this American Rescue Plan Act extended it again through Labor Day. So, again, we've had still some slack in the labor market, even as other economic indicators have done very well. So the Fed has kind of indicated this is a bigger concern. So, extending it for long-term unemployed has been a policy focus. So that did get extended through Labor Day. Additionally, unemployment benefits were extended for those who would not otherwise qualify, who are not technically unemployed, such as independent contractors and part-time workers who can verify that they had a significant reduction in hours or work. They would qualify as well. And then one additional tax benefit, if you'll notice this last point here, is for 2020, if somebody, and this applies for any tax filing status, if your adjusted gross income was under 150,000 and you received unemployment compensation in 2020, then up to $10,200 is excluded. So that was a little bit of a tax benefit for folks who collected unemployment, because traditionally 100% of your unemployment compensation is subject to federal taxable income. So that was a little bit of a tax benefit for folks who received unemployment. Okay, so then kind of going to, so we kind of addressed the stimulus payments, the unemployment benefits, so the kind of the direct payments. Another significant component who helped people who were unemployed and switching to COBRA was the federal subsidy for people on COBRA. So for anybody who had either lost their job, had a reduction in hours, or were furloughed, and as a result qualified for continuation of their health coverage under COBRA, the federal government is now going to subsidize 100%, so pay the entire premium, health insurance premium in a 6-month window from April 1st to September 30th. So anybody who's been on COBRA knows that can be a pretty substantial cost if the employer is no longer contributing their part of the premium. So for folks on COBRA, this could actually end up being financially more beneficial than the stimulus payments, and was actually kind of a point of contention because that kind of incentivizes people to stay on COBRA, which is more expensive versus going to the ACA marketplace. So that was a little bit of a point of contention in the bill, but rightly or wrongly, so that's a pretty substantial benefit. One important point is this does not apply to individuals who voluntarily leave employment. So if you voluntarily leave employment, you can, in certain circumstances, qualify for COBRA, but the federal subsidy will not apply. And then additionally, if individuals were already on COBRA and they had a maximum period of coverage that ended, which is typically 18 months prior, or sometime during this window prior to September 30th, then the federal subsidy will end as well. So it's not a blank check to kind of go all the way through September 30th. So the COBRA piece is a pretty significant benefit to people who are on COBRA, receiving on COBRA insurance right now. And then secondarily, there were some tweaks to individuals who purchased health insurance through the ACA marketplace, that they modified their calculations for affordability percentages when calculating tax credits for the health insurance premium paid. So generally for these folks, it effectively lowered their healthcare, or has the effect of lowering their healthcare costs. So if you are a participant in the ACA marketplace, I definitely encourage you to speak with a tax professional, because they can be kind of particular with the calculations. But from a big picture perspective, we saw a little bit of benefit there as well. So we definitely saw some benefits on the health insurance front going through. Okay, so kind of moving on to the tax credit. So we know that We know that most of our clients who are working kind of towards the end of their careers, most likely will have kids either in college or kids that have started their own families, have grandkids that apply to them. But we definitely saw a robust expansion of a number of these credits that benefit people with children. One of which was the child tax credit. So for 2021. The credit was increased 50% from $2,000 to $3,000 per qualifying child. And then for children under the age of 6, it's $3,600. And it is subject to phase out based on modified adjusted gross income. So this is a slightly different calculation than adjusted gross income. Most of the phase outs we've seen in the tax code are based on adjusted gross. Modified gross is very similar. There are a few deductions that you have to add back into adjusted gross income to get modified. So if you had self-employment tax, half of that, or student loan interest and a few other things, some minor deductions that would change the calculation. But for majority of tax filers, modified adjusted gross is identical to adjusted gross income. And we'll talk about that phase out in just a second. But in addition to increasing it for children under the age of 6, it also allowed children who are 17 years old to qualify for the child tax credit as well, whereas only 16-year-olds prior to 2021. And so going back to the phase out levels, so again, similar to what we saw for the stimulus checks, it starts out at $75,000 per individual, $150,000 for married filing jointly, and $112,500 for head of household. And the rate at which the excess credit gets phased out, so that additional $1,000 is $50 for every $1,000 of modified adjusted gross income over the threshold amount. So for example, if you're married filing jointly and your modified adjusted gross income is $170,000, so you've got $20,000 over the threshold amount. So you're going to get a $50 times 20 is going to be a $1,000 reduction. So that wipes out all of your excess credit from $3,000 back to $2,000 per child. But the good news is if that goes away, if your modified adjusted gross is above that, you still get to keep the base credit, which applies in the previous year's tax rules, and that starts to get phased out at $400,000 of married filing jointly. So there is an additional benefit that starts to get phased out, but you keep the base. So that was a little perk for people with children as well. And then they made the credit fully refundable for 2021. So refundable credit, meaning if you have no tax liability at all, you still get and you have some leftover credit, you still get it. You still get the additional delta, the change in the credit. Lastly, and again, this will tend to be more for lower income folks, that the Treasury Department is expected to start making advance payments of the child tax credit. So rather than getting a lump sum in your tax refund at the end of the year, they're intended to kind of speed up the process and get it up to half of the credit, the excess credit, in people's hands to help them with their day-to-day expenses over the course of the year. So it's kind of an acceleration in the benefit rather than having a big refund. So in addition to the child tax credit, kind of going hand in hand with that is the child and dependent care tax credit. So if you have qualifying dependent care expenses, so you have a child in daycare, you have a nanny, et cetera. So those dependent care expenses will qualify you for a credit. So in 2021, again, we had the legislation passed, made this benefit more robust. So the maximum credit has been increased to $4,000 for a qualifying child, and then $8,000 for 2 or more, and that's up from $3,000 and $6,000 previously in 2020. So as the law currently stands, you do not get a dollar for dollar credit for each dollar you spend. So if you spend $1 at the Primrose School, you do not get $1 in credit. In 2020, you got 35 cents on the dollar. So you notice the credit was 35%, and that increased to 50%. So now you get 50 cents on the dollar. So not only is the cap higher, but the percentage of the expense that you can use as a credit is also increased as well. And again, we have the phase out, and it applies to adjusted gross income, not modified. and above 125,000, and this is regardless of your filing status, single, married, filing jointly. We have a slightly different calculation, but the credit percentage is reduced by 1% for every 2,000 increase in AGI. So for example, if we go $10,000 above AGI, we're going to get a 5% drop in the credit. So instead of getting 50% of your expenses, you get 45%. Okay, and then that will continue to drop down. You can go from 50% all the way down to 20% of your expenses, and then it will hold at 20% until your adjusted gross income goes to 400,000, and then start to decrease again to reach zero. So again, there is a little bit more of a calculation there, but the good news is the numbers have reset higher if you either you or your children have families that have young kids who have daycare expenses. This is definitely helpful. And again, the same thing, that the credit is fully refundable. So we have two areas where we're giving more credit to people with children, and with the child tax credit, we're trying to get the dollars in their hands over the course of the year. Okay. Okay, and then another thing that you hear about quite often, earned income tax credit. So this is for people who tend to have lower incomes and have earned income. They made this more robust for the credit more robust for individuals who do not have qualifying children. So again, 99.9% of our clients, this is not going to apply to. But if you have a child that recently graduated or started working and is no longer claimed as a dependent by you, but has some earned income, can qualify for the earned income tax credit. So this credit actually tripled from $543 to $1,500 and some change. And the adjusted gross income threshold increased as well from $8,800 to $11,610. So again, it's a low level of income, but for people in certain circumstances who just started working, changed jobs, didn't have jobs, it's definitely an opportunity to get a substantial credit. In addition to that, increasing these dollar values, they also reduce the minimum age for which the credit can be claimed from 25 to 19. And if you're a full-time student, it's at 24. And the maximum age limit was eliminated, and that's not applicable for most folks. But again, to qualify, this is specifically applicable to individuals with no qualifying children. There are no such age limits for people who do have qualifying children. So those are a little bit benefits, again, for people in a specific subgroup that could take advantage of this. In addition, there's some other benefits in that you can utilize your 2019 earned income in lieu of your 2021 for the purposes of calculating the credit in 2021. So for example, this is to benefit people who are working in 2019, didn't have jobs in 2020 or 2021, so they can use that earned income history to get this credit. So again, helping people who have earned income. And then there are a couple of other benefits. One of which is, so there also is a limit as to how much investment income somebody can have in order to claim the earned income tax credit. So going back to the example of your child who just started working, if he or she, if you gave them a brokerage account or gave them some stocks, or they have an investment account where they have dividends and capital gains, if they had income that went over $33,650 from investments, they were disqualified from getting that tax credit. So now that in 2021, they increased that threshold to 10,000 and index that to inflation. So for individuals who have some investment income, it does not disqualify them from getting the tax credit. So that's a little bit of benefit as well. And then there are a couple other benefits that are kind of more tangential, but the big picture is trying to expand this for people who who are working, who do not have qualifying children, kind of relatively new in their career. So a couple big improvements to the credits that definitely the credits that benefit some individuals. Another piece that was incorporated into this that's definitely applicable is relief for student loans. So we know on the legislative agenda, some Democrats have been calling for cancellation of student debt up to certain levels. That wasn't a component of this bill, but one thing that they did do is for individuals who had their student loans either forgiven, canceled, or discharged, between January 1st of this year through the end of 2025. So in this 5-year window, if for whatever reason, if these loans were discharged, canceled, those amounts would not be included in their taxable income. So normally when you have a debt discharged, canceled, including student loans, with a couple of rare exceptions, death or disability, those would be that amount would be included in taxable income. You have to pay tax on that. This rule or this component eliminated that requirement. So if you have students who got their loans forgiven, discharged, canceled, what have you, they won't have to pay tax on that forgiven, discharged amount. And then the caveat is, this does not apply to loans discharged by private lenders. This is just to federally backed loans. So, the question is this going to open the door for, student loan forgiveness or cancellation down the road? It's certainly possible, but again, it's too premature to say what the landscape is going to be going forward with that. So, with that being said, these are kind of some of the big, components that affect individuals. As I said earlier, there are a myriad number of, subsets and different spending groups, assignments here that we could talk about, and also longer term economic impacts, the concerns about inflation, what have you. So, that's something, if you have specific questions, we certainly would encourage you to, reach out, to feel free to contact us with any questions. We always offer complimentary and confidential retirement planning services, financial planning. So we encourage you to reach out. One of our advisors will be happy to meet with you if you have any specific questions about the presentation, kind of extensions from this, or your personal financial situation. We'd love to be a resource and meet with you and go from there. So with that being said, thank you all very much in attendance. And then I did have one or two questions that I wanted to answer. So we had a question saying, if a child was born early in 2020, should the family receive all 3 rounds of the stimulus for the child? And if they were not, how would they go about getting those? So that's a very good question. That was from Jonathan. So so there won't be, if you filed for 2020 with the child, or if you haven't filed your 2020 tax return, when you file that, you'll have that child as a dependent, so they can give you the credit for that. And you can always file in 2021 if you did not, for whatever reason, if they already sent the stimulus check before you filed your 2020, you can always get the rebate in the 2021 tax year and file for that as well. And if there's any questions, Jonathan, you can feel free to reach out to me directly and be happy to assist. But with that being said, I'd like to thank you all very much for your time, and thank you for your attending. And then, as I said, feel free to reach out with any, if there's any extensions or any other components of the act that you want to address. We'd be happy to talk about it, and if the need arises or interest arises, set up another webinar. But thank you very much for your time. We appreciate it.